Hi everyone. In the previous two videos, we began a discussion of periodic pension expense. We'll continue that discussion in this video. This illustration summarizes the possibilities of gains and losses that occur when estimates used to calculate the PBO are revised or when the actual return on plan assets differ from expected returns. A loss results if the liability for the projected benefit obligation is higher than expected. A gain results if the liability for the PBO is lower than expected. A gain results if the return on plan assets is higher than expected. And a loss results if the return on plan assets is lower than expected. As stated in the previous video, the Financial Accounting Standards Board, also known as the FASB, requires that we defer the recognition of plan gains and losses. However, the FASB acknowledged the conceptual shortcoming of delaying the recognition of gain or loss by opting for this more politically acceptable approach, which promotes income smoothing. The practical justification for delaying recognition is that over time, gains and losses might cancel out one another. Given this possibility, why create unnecessary fluctuations in reported income by letting temporary gains and losses decrease and increase the pension expense? Of course, as years pass, there may be more gains than losses, or vice versa, preventing their offsetting one another completely. So, if net gain or net loss gets too large, pension expense must be adjusted. The FASB defines too large rather arbitrarily as being when a net gain or a net loss at the beginning of the year exceeds an amount equal to 10% of the PBO or 10% of plan assets, whichever is higher. This threshold amount is referred to as the corridor. When the corridor is exceeded, the excess is not charged to pension expense all at once. Instead, a further concession to income smoothing, only a portion of the excess is included in the pension expense. In other words, don't include any planned gains or losses in pension expense unless the amount of net gain or net loss exceeds a threshold. If the accumulated net gain or net loss exceeds that threshold, then amortize the excess to pension expense over a period of years. The amount that should be included in pension expense is the amount of excess of net gains or net loss over the corridor divided by the average remaining service period of active employees expected to receive benefits under the plan. This is one of the slides we discussed when we first started talking about pension expense. In our illustration, we're assuming a net loss AOCI of $55 million at the beginning of 2021. Also, Global's PBO at the beginning of 2021 was $400 million, and the plan assets at the beginning of 2021 were $300 million. Based on this information, we are going to calculate the amount of the $55 million net loss that should be amortized to 2021 pension expense. There are 3 steps in this calculation. Step 1. Calculate the corridor. The corridor is 10% of the larger of the PBO or plan assets at the beginning of the year. In this example, the PBO is larger than the plan assets, so we calculate the corridor to be $40 million. That's the $400 million balance at the beginning of the year in the PBO times 10%. Step 2. Calculate the amount by which the accumulated net loss or net gain exceeds the corridor. In this example, net loss of $55 million exceeds the $40 million corridor by $15 million. 55 minus 40 equals 15. Step 3. Divide the excess of the net loss or net gain over the corridor by the estimated remaining service life of active employees, 15 years in this example. Dividing the excess of loss of $15 million by the average remaining service period of 15 years results in an amount to be amortized to 2021 pension expense of $1 million. 15 divided by 15 equals 1. Here's the calculation that we just went through. And to restate what we've just done, when amortizing net gain or net loss, the amount that should be included in pension expense is the excess of the net gain or net loss over the corridor divided by the average remaining service period of active employees expected to receive benefits under the plan. The pension expense is increased by the $1 million because a net loss is being amortized. If a net gain were being amortized, the amount would be deducted from the pension expense because a gain would indicate that the balance of the net cost of providing the pension plan had decreased. This amortization reduces net loss AOCI by $1 million. Here's the beginning net loss of $55 million that we talked about from the prior slide, minus the $1 million of amortization. But remember, there was some activity in 2021 that affected the net gain and net loss. Global incurred a $23 million loss in 2021 from revising estimates relating to the PBO and a $3 million gain when the 2021 return on plan assets was higher than expected. These three changes affected the net loss AOCI in 2021 as shown here. And the ending balance at the end of 2021 of net loss is $74 million. As we discussed earlier, gains and losses, either from changing assumptions regarding the PBO or from the return on assets being higher or lower than expected, are deferred and not immediately included in pension expense and net income. Instead, we report them as other comprehensive income in the statement of comprehensive income. So Global records a loss OCI for the $23 million loss that occurs in 2021 when it revises its estimate of future salary levels, causing its PBO estimate to increase. Global also records a $3 million gain OCI that occurred when the $30 million actual return on plan assets exceeded the $27 million expected return. Remember, remember, remember. The PBO, projected benefit obligation, represents a liability to the company. The loss is an increase to the PBO due to a change in an assumption or an estimate. In this entry, we are recording that increase to the PBO as a credit. Credit the liability to increase its balance. Debit loss OCI, $23 million. Credit PBO, $23 million, an increase to that PBO liability. Similarly, the gain due to the actual return on plan assets exceeding the expected return is an increase to the plan assets. Debit plan assets, $3 million. Credit gain OCI, $3 million. Well, that's all for this video. In the next video, we'll conclude our discussion of periodic pension expense.